Many beginner investors are persuaded to buy a stock just to earn dividend.
Here are my top 4 dividend stocks for you to consider.
5 of the best dividend stocks to buy.
7 dividend stocks that you might want to own as part of your portfolio.
Many beginning investors don't know what a dividend is in relation to an investment, especially one that involves an individual stock or mutual fund. Let us explain it to you. A dividend is when a publicly traded company pays out a portion of its profits to eligible stockholders. But not every business pays a dividend. Typically, a company's board of directors decides whether a dividend is desirable based on a variety of financial and economic factors. On a monthly, quarterly, or annual basis, dividends are typically paid to the shareholders in the form of cash distributions. Before receiving a dividend payout or distribution, shareholders of any particular stock must satisfy a set of conditions. To be eligible for the dividend payment, you must be a shareholder of record on or after the date specified by the board of directors of the company. When a stock is said to be trading ex-dividend, it simply means that it is not eligible for a dividend on that specific day. You won't get the most recent dividend payment if you buy and sell stock on the ex-dividend date. Now that you know the basics of what a dividend is and how it is paid out, let's look at the good, the bad, and the ugly side of dividend investing that no one talks about. Dividend-paying stocks offer several advantages to investors, including income generation, stability, and lower volatility. One significant benefit is the regular stream of income provided by dividends. Companies that pay dividends distribute a portion of their profits to shareholders, typically on a quarterly or annual basis. This consistent income can be especially appealing to investors seeking a reliable cash flow. Moreover, dividend-paying stocks tend to be more stable and less volatile compared to non-dividend-paying stocks or growth-oriented companies. Established and mature companies that pay dividends often have a solid track record and financial stability. During market downturns, dividends can act as a cushion, helping to offset potential losses in the stock price and providing a sense of stability for investors. In addition to income generation and stability, dividend-paying stocks contribute to total return. Total return encompasses both capital appreciation and dividend income. By reinvesting dividends, investors can take advantage of compounding returns, potentially leading to higher overall investment gains over time. Another advantage of dividend stocks is the potential for dividend growth. Some companies have a history of increasing their dividend payments regularly. Dividend growth stocks not only provide income, but also offer the opportunity for growing dividends, which can help maintain purchasing power and potentially outpace inflation. Lastly, dividend-paying stocks can have favorable tax treatment in many countries. Dividends may be subject to lower tax rates or qualify for certain tax credits, making them more tax efficient for some investors. Understanding the tax implications and taking advantage of any available tax benefits can be an additional advantage of investing in dividend-paying stocks. Dividend-paying stocks, while often sought after for their regular income, do come with several potential drawbacks. Firstly, these stocks may have limited growth potential as companies paying dividends are often already in a mature stage with fewer opportunities for significant expansion. Additionally, dividend payments are typically subject to taxation, which can diminish overall returns, particularly for investors in higher tax brackets. The reinvestment options for dividends may be limited, preventing investors from diversifying their portfolios across different stocks or asset classes. Furthermore, employing a dividend capture strategy can be challenging, as share prices often adjust downward after the dividend is paid, potentially negating any gains. Lastly, there is the risk of dividends not keeping pace with inflation, resulting in a diminished purchasing power over time. While these factors should be taken into account, they do not render dividend-paying stocks inherently bad investments, but rather aspects that investors should carefully consider alongside their individual circumstances and investment objectives. The ugly side is that dividends are never guaranteed. Companies can and do reduce and even eliminate their dividends. During the COVID-19 pandemic, some very prominent old guard stocks have done so. Wells Fargo, Dick's Sporting Goods, Carnival, Goodyear Tire and Rubber, HSBC, Airbus, and Rolls-Royce, just to name a few. In other words, dividends are not guaranteed and are subject to macroeconomic as well as company-specific risks. Another potential ugly side to investing in dividend-paying stocks is that companies that pay dividends are not usually high-growth leaders. There are some exceptions, but high-growth companies usually do not pay sizable amounts of dividends to their shareholders, even if they have significantly outperformed the vast majority of stocks over time. Growth companies tend to spend more dollars on research and development, capital expansion, retaining talented employees, and mergers and acquisitions. For these companies, all earnings are considered retained earnings and are reinvested back into the company instead of paying a dividend to shareholders. It is equally important to beware of companies with extraordinarily high yields, because if a company's stock price continues to decline, its yield will go up. Many rookie investors get teased into purchasing a stock just on the basis of a potentially juicy dividend. There is no specific rule of thumb in relation to how much is too much in terms of a dividend payout. You should exercise caution when considering dividend-paying stocks due to a few key factors. Firstly, the sustainability of dividend payments is crucial. While dividends can be an attractive source of income, you need to thoroughly analyze the company's financial health and cash flow to ensure the dividends are sustainable in the long run. A company with declining earnings or excessive debt may struggle to maintain its dividend payments, leading to a reduction or even elimination of dividends. You should also scrutinize the company's dividend history, payout ratio, and overall financial stability to gauge the reliability of future payments. Secondly, focusing solely on dividends can limit your investment opportunities. You may be tempted to chase high dividend yields without considering the underlying fundamentals of the company. A narrow focus on dividend stocks may lead to a concentration of risk in a specific industry or sector, making the portfolio vulnerable to market fluctuations and sector-specific risks. It is essential for investors to maintain a balanced approach, considering other factors such as capital appreciation potential, overall growth prospects, and risk management strategies alongside dividend payments. While dividend-paying stocks can offer attractive income potential, you should exercise caution. You must carefully evaluate the sustainability of dividends and consider a well-rounded investment approach that incorporates diversification and long-term growth prospects. Conducting thorough research, analyzing financial statements, and understanding the company's business model are vital steps to mitigate risks associated with dividend investing.